Hi everybody, the role of the central bank is much more diverse than you might think. We've spent a lot of time throughout the macroeconomics course looking at the role of the central bank to implement monetary policy, to influence the money supply, to set interest rates in order to meet an inflation target, and to make sure other macro objectives like growth and unemployment are being looked after as well. We've also looked about how monetary policy can involve changes in the exchange rate, which the central bank can do too. So to implement monetary policy to meet an inflation target, we spend so much time looking at that, we understand that. There is another role here, which is the central bank, like the Bank of England, acting as a banker to the government. We've learned that in order to set interest rates, the central bank will need to alter the money supply. And one tool available to the central bank is open market operations, engaging in the buying and selling of government bonds. Now in the UK that's not a big deal. In the US that's a much bigger deal. That's how the Federal Reserve over there will set interest rates. In that sense, the central bank can buy and sell government bonds on behalf of the government. In that sense, acting as a banker to the government. The central bank can also look at funky ways to reduce the interest rate paid by the government on government bonds. So in that sense, acting as a banker to the government, buying and selling of government bonds and reducing interest rate paid on government bonds. But there are also two crucial roles that the Bank of England will have in particular, the financial stability roles of the Bank of England, which have become a much greater responsibility of the central bank given the 2008 financial crisis. So after that, these two have become massive, massive deals for the Bank of England. First of all, to act as a banker to the banks, to act as a lender of last resort to the banks. This is all about preventing a bank run, to get involved, if need be, when there is a liquidity crisis for a commercial bank. Now we know all about liquidity crisis when the short-term liquid assets that a commercial bank has is not enough to meet the short-term liabilities that a commercial bank has. We know that that can create panic, there is a liquidity crisis, the end result could well be a bank run here. There is a role for the Bank of England to step in and to intervene. It's called the Liquidity Assurance Scheme. And there are two kind of branches of this scheme, where the central bank, the Bank of England, can offer non-emergency liquidity for commercial banks that just need, periodic liquidity, maybe, monthly or something, so not short-term, high-intensity, large-scale liquidity right now, but just periodic liquidity just to keep them through for the next few months. So that's non-emergency liquidity. You've also got the emergency liquidity branch here, where you've got a commercial bank that's in dire concern. They need large-scale liquidity, they need it right now. That's emergency liquidity. The central bank can also offer that kind of liquidity assurance. That's the lender of last resort function. And the central bank will do it if they feel like systemic risk is a big concern. The whole meltdown of the financial system is a risk here. In which case they'll say, look, we don't want to let this bank fail, we don't want liquidity to be an issue, we're going to step in and intervene. What central banks won't do often is intervene if a bank goes insolvent. That's when a bank makes bad decisions, they issue too many risky loans, they go bad, there's not enough capital to offset the loss in loan value, and they go insolvent as a result. The bank will simply say, well, too bad, you made bad decisions, you're just going to go bankrupt. You need to know that the Bank of England has got a fail-safe way of letting banks fail. So even if they don't want to intervene when it comes to offering liquidity, because that commercial bank doesn't meet the requirements, it hasn't met the conditions to get that liquidity, or if the bank goes insolvent, the Bank of England have got ways in which a commercial bank can fail safely, whereby the savings of individuals can be protected, where individuals can maybe divert their funds to other banks in an interim period. So it's not always the case of, well, we're going to bail you out. Insolvent banks often won't be bailed out, and even banks who are in a liquidity crisis may not be bailed out. But if the central bank feels that they want to, there is a need to, there is good rationale to, there are two branches in this liquidity assurance scheme whereby commercial banks can access liquidity through the Bank of England. The other role the Bank of England has is to regulate. The other role the Bank of England has is to regulate the financial system again, powers which are now much greater since the 2008 financial crisis. So these two are financial stability roles that you must be aware of, significant roles. And these are very important to maintain confidence in the financial system, to prevent panic and a run on the bank, as we've just said, to make sure that the risk of financial instability is lower, to make sure that systemic risk is lower and the chance of financial system collapse is much lower, And also, if need be, if there is a rationale for a bank bailout, so even for an insolvent bank, the Bank of England says, look, we don't want to bail you out, but actually it might be in the best interest of the financial system and the interest of society as a whole for this bank to be bailed out, then they can advise the government on bank bailouts to prevent wide-scale financial collapse, which can cause deep financial crisis and deep recession. So it's important that that role is there to make sure that all these things are looked after and to make sure that bank failure and systemic risk isn't that much of a concern. Let's now evaluate the lender of last resort function of the Bank of England. From this video onwards in my playlist, I'm going to focus on these two roles in lots and lots of detail. So if you want to evaluate the role of regulating the financial system, watch my video on that, which is towards the end of this playlist, to get a really detailed understanding of how they regulate the financial system, what can go wrong with that kind of regulation. But I'm just going to focus now on evaluating the lender of last resort function of a central bank. I want to clarify at this stage, when I talk about liquidity, it's not just free money that the commercial bank can get. If it's non-emergency liquidity, there'll be interest paid back on that, there'll be conditions or regulations imposed on the commercial bank afterwards. If it's emergency liquidity they need, there'll be even higher interest that the commercial bank will have to pay this money back to the Bank of England, and there'll be even stricter conditions, even stricter regulations in the future to prevent this happening again. We're going to evaluate that right now. Well, one major issue of this function is that the Bank of England might be promoting moral hazard. Moral hazard occurs when a risk is taken, a decision is taken, where if that decision goes bad, the cost is borne by a third party. So the third party in this case is the Bank of England, right, having to provide this emergency liquidity. You just encourage more of that behaviour, because a commercial bank knows that if ever they don't have liquidity, they can always run to the central bank and gain liquidity there. Linked to that is the idea that banks may simply just never hold sufficient liquidity, knowing that they've always got the central bank to hold their hand and to provide liquidity, whether non-emergency or emergency liquidity, if ever they need it, right? So a bank may decide that actually let's take greater risk, let's try and make more profit and not hold as many short-term liquid assets, let's actually lend out longer term. Because that's more profitable for us. And if ever our depositors come back and they need money, if ever we need to fulfill our short-term liabilities, well, we'll just run to the central bank if we need to. If we need to pay a bit of interest on that, even more interest on that, do you know what, let's do it, because the profit we can make is so much greater. You encourage that kind of activity when you've always got someone there on the side that's going to hold your hand, that's going to be there to protect you. Dangerous kind of incentives you're promoting with this function as a lender of last resort. The risk of regulatory capture. Absolutely. Regulatory capture, remember, is when the regulators might be influenced because they've got buddies who still work in the industry. The best regulators we know are those who have actually worked in the industry before. Chances are they've still got really good contacts with people who still work in the industry. Regulatory capture is when those who still work in the industry, so maybe managers of a central bank, actually get in contact with regulators who work for the Bank of England and say, look, you're providing us emergency liquidity, but just lower that interest rate a little bit for us, because you're a buddy of mine, you can do that for me, right? Or they say, look, I know you're going to impose strict conditions and regulations, but maybe because I know you really well, just make them a bit lax for us, make them a bit easier for us. That's regulatory capture, and there is a risk of that. Okay, if there is this, if there are these strong relationships between regulators and inside workers in the financial industry. And also, this is a good point to evaluate, right? Why should banks have this luxury of getting emergency liquidity, of essentially being helped out in times of crisis, when other firms in the industry don't have this luxury? If they go into trouble, well, off you go, you're bankrupt, goodbye, do something else. Whereas banks, they might have a way of continuing with this emergency liquidity that the central bank offers. Why is that fair? Why should they get this and not other firms? Well, you might say, it's individual savers that have their money in the commercial bank. Well, if the Bank of England say that there is a fail-safe way of letting a bank fail, then why not just let the bank fail? And also in the UK, £75,000 of individual savings are backed by the government for each account that an individual saver has. So therefore, actually, savings are not necessarily at risk. Why not just let the bank fail? Why are they so special? Especially if the Bank of England go whoop-de-doo and they go all blasé and all boastful about how they're so clever they can let a bank fail. Then why? Why is there so much intervention? Why is there so much emergency and non-emergency liquidity? Even the idea of a bailout, why should that be allowed to take place? When other firms don't have the same luxury. Nice evaluation point to consider. That covers this, guys. Very important role of the central bank, very diverse, lots to take in. I'll see you all in the next video.